Silver just fell again, down more than 2.5% in a single morning, slipping from over $60 an ounce to levels few analysts expected this soon. But here is what almost no one is talking about. While headlines focus on the drop, a quiet shift is happening inside coin shops across the country. Buyers are not walking away from silver. They are changing exactly what kind of silver they trust. One category is being melted into oblivion, another is vanishing off shelves within hours, and a third, something almost no one expected, is now commanding premiums that make no logical sense. By the end of this story, the pattern behind these decisions will become impossible to ignore, because what stackers are quietly choosing right now may be signaling something far bigger than a price dip. Stay until the end, because Part 5 reveals the one detail almost every investor is currently overlooking. Welcome back to Precious Metals Intelligence. This channel exists for one purpose: to translate market noise into strategic clarity for those who take their financial decisions seriously. The numbers told a simple story on the surface. Silver had closed out the previous week at just over $60 an ounce. It seemed like a strong finish, a moment of stability in a market known for chaos. But that calm did not last. By Monday morning, the price had already slipped again, falling by more than $2, a drop of nearly 3% before most people had even finished their morning coffee. For anyone watching closely, this was not a shock. It was simply the latest chapter in a pattern that had defined silver for months. A quick look at the 3-month chart revealed the full picture. Sharp peaks, sudden valleys, prices climbing above $87 at their highest point, then collapsing to under $58 at their lowest. This was not a market moving in a straight line. It was a market swinging like a pendulum, testing the patience of everyone who held a position in it. What made this moment stand out, though, was not the drop itself. It was the timing. Silver was now trading at roughly half of what it had reached at the end of January. That kind of decline usually sends buyers running for the exits. Fear takes over. People stop buying and start waiting, hoping for a bottom that never seems to arrive. But something different was happening this time. Instead of retreating, people were showing up. Interest in physical silver was rising again, not falling. This is where the real story begins. Because the important question was never simply whether people were buying. That question had already been answered. The real question, the one that mattered far more, was what exactly they were choosing to buy. In every coin shop, in every online store, in every transaction taking place across the country, a quiet decision was being made by ordinary buyers. And that decision was about to reveal something far more valuable than any single price chart could show. Coin shop owners on the front lines of this market were noticing the shift firsthand. Customers were still walking through the door. Orders were still coming in online, but their preferences had changed. There was a clear pattern in what people wanted, and it had little to do with brand names or government backing. It had everything to do with one simple factor: cost above the metal's actual value, known in the industry as premium. Despite prices being cut nearly in half since January, buyers still refused to overpay. They were not interested in paying extra just for a name stamped on a coin. This might seem surprising at first. Logic would suggest that during a steep price drop, buyers would rush toward the most trusted, most recognized products on the market. Instead, the opposite was happening. Well-known government coins, the kind carrying decades of trust and recognition, were sitting quietly on shelves while lower-cost alternatives moved quickly. This detail is not a small one. It points to a deeper shift in how people are thinking about their money right now. In uncertain times, buyers are not chasing prestige. They are chasing value. They are looking past the label and focusing on the raw material itself, calculating exactly how much metal they are getting for every dollar spent. This is a mindset shift, and mindset shifts often appear before larger economic movements become visible to everyone else. There's a lesson hidden inside this behavior, one that extends far beyond silver coins and bars. When markets grow unpredictable, people naturally return to what feels most certain. They strip away decoration. They ignore reputation built on marketing alone. They focus on substance. This is not panic buying. It is calculated buying, driven by people who have lived through enough market cycles to know that price swings come and go, but the fundamental value of what they hold does not disappear overnight. So, while the headlines will continue to focus on the falling number, the real story is happening quietly beneath the surface. A shift in buyer psychology is underway, one shaped by experience, caution, and a search for genuine value in an environment full of noise. Understanding this shift is the first step toward understanding everything that follows. Because what people are choosing to buy right now is about to explain something far bigger than a single day's price movement. It is about to reveal exactly how serious investors are preparing themselves for what comes next. There's a number that most casual buyers never think about, yet it decides almost every transaction happening in the silver market right now. That number is called the premium. It is the extra amount a buyer pays above the actual metal price, and in this current environment, it has become the single most important factor driving decisions. Price of the metal itself has taken a back seat. Premium has taken the wheel. Across shops and online platforms, one trend keeps repeating itself. Buyers are gravitating toward plain, generic silver, simple rounds, basic bars, items with no special design, no mint story, no collector appeal, just pure, unbranded silver sold as close to spot price as possible. This might sound unremarkable at first, but it actually reveals something important about how people are thinking during this downturn. They are not buying for excitement. They are buying for efficiency. This becomes even clearer when looking at what buyers are avoiding. Government-issued coins, the kind long considered the gold standard of trust in this industry, are struggling to move at the pace one would expect. These are coins backed by national mints, coins with guaranteed weight and purity, coins that have built decades of credibility. Logic would suggest that during uncertain times, buyers would flock toward this kind of security. Instead, sales have remained surprisingly flat, even though premiums on these coins have dropped to some of the lowest levels seen in years. This creates an interesting contradiction. Buyers are being offered trusted, government-backed silver at historically low added cost, and yet they are choosing to look elsewhere. The reason comes down to psychology rather than logic. People have grown so focused on stretching every dollar that even a small premium difference is enough to push them toward the cheaper alternative, regardless of the reputation attached to the more expensive option. Then there is a second category quietly gaining ground. 90% silver, often found in older coins once used as everyday currency. This type of silver is currently selling under spot price in many locations, making it an appealing option for buyers focused purely on getting the most metal for their money. Yet even here, the story is not simple. Many newer buyers hesitate before purchasing this type of silver, and the hesitation has nothing to do with price. It has to do with confusion. Calculating the exact silver content inside an old coin requires a bit of math. A buyer has to know the coin's weight, its purity percentage, and how that translates into actual ounces of silver. For someone new to this market, that calculation feels complicated and intimidating. Compare that to buying a coin or bar clearly marked with its exact weight and purity, something that requires no calculation at all, and the appeal of simplicity becomes obvious. Many buyers are choosing convenience over complexity, even when the more complex option might offer better value. This single detail explains a great deal about current buyer behavior. People are not necessarily choosing the smartest option available. They are choosing the option that feels the easiest to understand and trust in a moment of uncertainty. When someone already feels nervous about falling prices and unpredictable markets, the last thing they want is another layer of confusion added to their decision. Simplicity becomes a form of comfort, even when it is not the most cost-effective path available. This pattern reveals something important about how people behave during periods of financial stress. It is not always about finding the absolute best deal. It is about finding the option that requires the least mental effort while still feeling safe and reliable. Uniform bars and rounds fit that need perfectly. They can be stacked, stored, and understood at a glance without requiring any background knowledge of historical coinage or melt value calculations. What emerges from this behavior is a clearer picture of the modern buyer during uncertain economic periods. They are cautious, they are cost-conscious, and they are drawn towards simplicity as a way of managing anxiety in a market that already feels unpredictable enough. This shift toward low premium, easy-to-understand silver is not just a passing preference. It is a signal of how people are adjusting their entire approach to protecting their money. And this shift raises an important question that becomes even more relevant in the next part of this story. If simplicity and low cost are winning today, what happens to the other side of the... To understand why so many buyers hesitate around 90% silver today, it helps to look backward. Just a few years ago, the story around this type of silver looked completely different. Demand was intense. Buyers were lining up to secure old coins containing this alloy, and shops were charging premiums that reached nearly double the spot price at times. People paid those prices willingly, convinced that owning this piece of history was worth the extra cost. That memory has not faded. It lingers in the background of every transaction happening today, shaping decisions in ways many buyers may not even fully recognize. Because now, the situation has flipped entirely. Instead of paying a premium far above spot price, buyers can walk into a shop and purchase 90% silver for less than its raw metal value. On paper, this looks like an incredible opportunity. In practice, it has left many earlier buyers feeling burned. Consider someone who purchased this silver years ago, back when premiums were sky high. If that same person tries to sell today, they face a harsh reality. Shops are not just offering lower prices because spot value has dropped. They are offering buyback rates that sit far below spot itself, sometimes as much as $9 under the current market price per ounce. For someone who once paid nearly double spot to acquire that silver, watching it sell back for far less than spot creates a painful kind of whiplash. This experience does not stay isolated to a single transaction. It spreads. Stories like this circulate among friends, family members, and online communities. A single bad experience with volatile premiums becomes a cautionary tale repeated to newer buyers considering their first purchase. And so the hesitation grows, not because 90% silver is a poor product, but because its pricing history has taught a difficult lesson about unpredictability. This is where an important distinction becomes clear. The volatility scaring people away is not really about the price of silver itself. Everyone already understands that silver prices rise and fall. That kind of movement is expected, and to some degree, accepted as part of owning any precious metal. What catches people off guard is a different kind of volatility, one tied directly to premiums. Watching the extra cost above spot price swing wildly from nearly double spot at the peak to deeply discounted buyback rates today creates a far more unsettling experience than simple price movement alone. This pattern is not unique to 90% silver either. Similar swings have shown up in other popular products within this market, creating a broader sense of caution among buyers who have lived through these cycles before. When someone remembers paying an enormous premium during a moment of high demand, only to see that same premium evaporate or reverse entirely once demand cools, it changes how they approach future purchases. Trust erodes slowly, and it takes far longer to rebuild than it does to break. Yet within this story of caution lies an interesting twist, one that experienced buyers are beginning to notice. As buyback prices remain low, large amounts of 90% silver continue to be melted down for their raw metal value, rather than kept in circulation as collectible coinage. This steady disappearance from the marketplace is gradually reducing the overall supply available to future buyers. Fewer coins remain in circulation, even as demand has not disappeared entirely. This creates the foundation for what many longtime participants in this market describe as a natural cycle. Supply shrinks. Interest eventually returns, often triggered by broader economic uncertainty or renewed attention toward physical assets. And once that renewed interest meets a shrinking supply, premiums tend to rise again, sometimes sharply. Those who continue quietly accumulating 90% silver during this current period of low premiums and cautious sentiment may be positioning themselves ahead of that next shift whenever it eventually arrives. This is the deeper lesson hidden within the 90% silver story. Price alone rarely tells the full picture in any market. It is the relationship between price, premium, and supply that ultimately shapes long-term value. Those paying close attention to that relationship today, rather than reacting purely to short-term price swings, may find themselves in a very different position once the cycle inevitably turns again. While generic borrowers and cautious buyers dominate one side of this market, a completely different story is unfolding on the other side. It involves silver that has nothing to do with low premiums or simple math. It involves scarcity, and scarcity is proving powerful enough to override every rule that seems to govern the rest of the market right now. Consider what happens when someone needs quick cash today. If they own a mix of silver, including plain rounds and rare collectible pieces, which item do they choose to sell first? Logic might suggest they would part with ordinary bullion, since that is the most common and easiest to replace. Instead, many are doing the opposite. They are reaching for their most valuable, high-premium collectible pieces first, items like graded coins or limited releases, because these bring the highest return per ounce sold. A plain round might fetch only a few dollars over spot. A sought-after collectible piece can bring in 10, 15, sometimes far more above spot value. This behavior reveals something important. When people need to maximize the dollars they receive during a downturn, they do not sell what is easiest to part with. They sell what commands the strongest price, even if that means letting go of something they once considered a prized piece of their collection. Financial need is reshaping collections in real time, and the pieces disappearing fastest are often the rarest ones. One example stands out clearly in this pattern: the Mexican Libertad. These coins have become remarkably difficult to keep in stock. Dealers describe selling out within a single day of posting availability. The reason traces back to a decision made by the mint itself when production numbers were sharply reduced for a recent release. Only a small number of coins were produced that year, and when supply shrinks that dramatically, prices react in dramatic fashion. Some of those limited coins reportedly sold for prices reaching well into five-figure territory once graded and certified, an almost unthinkable price for a single ounce of silver minted just months earlier. This kind of scarcity-driven demand is not confined to older or rare releases either. It appears in brand new products as well. A recent limited mintage metal produced in extremely small numbers sold out almost immediately and then reappeared on secondary markets at prices far above its original release cost. Items originally priced in the hundreds of dollars were changing hands for over 1,000 within days, driven entirely by the fact that so few existed in the first place. This pattern raises an important question. Why are people willing to pay such extreme premiums for items with limited supply, while simultaneously refusing to pay even a small premium on well-known government coins with far greater availability? The answer lies in perceived exclusivity. A widely available government coin, no matter how trusted, does not carry the same emotional pull as something scarce and difficult to obtain. Scarcity creates urgency, and urgency drives buyers to abandon their usual cost-conscious instincts entirely. There's also a quieter shift happening beneath this collectible boom. As 90% silver becomes more affordable, some buyers are rediscovering old coins sitting untouched in drawers and collections for years. That rediscovery is sparking fresh interest in numismatics more broadly, as people begin researching the history and rarity behind coins they once viewed only as raw metal. This growing curiosity adds another layer of demand into an already complicated market. What ties all of this together is a single insight. While spot prices swing wildly and premiums on ordinary bullion shrink toward historic lows, an entirely separate market built on scarcity and collectability is thriving, almost immune to the volatility affecting everything else. Understanding why that divide exists and what it reveals about where serious money is quietly moving right now sets the stage for the final and most important part of this story.